All right, appreciation. So this is the fifth and final way that real estate pays you. And I put it last for a reason because I think most people, as I mentioned earlier, they think about appreciation first when they're thinking about investing in real estate. When you talk to someone who bought a primary and just kept it forever, they're really proud of the appreciation of that home. And it gets thought of first. But I think in our perspective, it should be thought of last. It's the cherry on top. We know that over time, historically, home values have gone up. We also know that this is subject to market cycles. So yes, while the trajectory is up, there is still some up and down, depending on what the market is doing. The thing you've got to remember about appreciation is that your gains are unrealized unless you're selling the property or unless you're trying to tap into that equity. So to get obsessed with the appreciation or super concerned with the depreciation of your property, I think is unfair. I think it's like checking your stock portfolio every day. You can go online and check and see what your stocks are at, and they're up and they're down and they're up and they're down, and you can feel rich and poor and rich and poor, but the reality is it's all hypothetical until you exit, right? Or until you do something with that money. It's the same thing with real estate. So I think of more people during the last crash who didn't get themselves in lending problems. I think if more people had kind of calmed down when they saw their property value kind of plummet a little bit, if they had calmed down and they had bought the kind of property that we think you should buy, one that cash flows, they could have weathered that market cycle, and they could have come out the other side of it. And property values, of course, are higher now than ever. And so it's important to keep in mind appreciation is great, but it's unrealized until you actually sell it. So I wanted to give you kind of an idea of typical returns in a linear market and a growth market. These are kind of two categories of how we loosely define the different market types that we recommend you invest in. Linear markets are markets that are generally a little more boring. They're a little bit more flat. They're linear. Property values are increasing over time, but it's slow, gradual appreciation. So generally we see between 0 to 3% annual appreciation in a linear market. Then we have a growth market, which are markets that are more positioned for appreciation. So these are markets like Texas and Florida, where there's just a tremendous amount of job growth and population growth. And so we're seeing a steeper growth trend in those markets. We generally say, expect 3 to 6% annually in those markets. But at the end of the day, appreciation is speculative. We don't know what's going to happen. We can guess, and we can hedge our risk based on what we think will happen. But at the end of the day, this is the piece we can't control. It's speculative, so it's got to be treated as such. It's the cherry on top. So to give you a little illustration of property values over time, Kathy Fecky uses this graphic all the time. I love it because it demonstrates this trend. Over time, property values are clearly going up. There we go, there's that trend line. So we can see that the sections in gray here are different periods of recession. So we can see the big whammy right there. In 2007 or 2008-ish to 2009, that's when the housing market fell out from under us. That was a really bad time to be selling real estate as property values just kind of plummeted. But look, over the last 10 years, they've recovered. And if you had been able to weather that, if you'd been able to hold on to that property, you were okay. You didn't suffer that property value. So over time, housing prices are appreciating. All right, so to recap, these are the 5 different ways. We've got cash flow, we've got principal pay down, we have tax benefits, we have the hedge against inflation, and then we have appreciation. So I wanted to talk through a couple scenarios because I think what's really important is that you don't hyper focus on any one of these categories. You've got to always kind of keep all of these different revenue streams in mind when you're analyzing property and when you're building a portfolio. So let's talk through these. The first scenario is if you're a cash buyer. Let's say you don't feel comfortable taking a loan, you don't want to take on new debt, you want to buy a property outright in cash. So let's see, how does that affect our cash flow? Well, cash flow is going to go up. If we own the property outright, it's going to cash flow more each month because we don't have that principal and interest payment due to a bank. So that increases. What happens to principal pay down? Well, that's eliminated because you no longer have a tenant that's paying off a debt for you. You already own it. So that income stream goes away. The tax benefits, we still get the tax benefits of investing in real estate, but we've reduced some of them. You know, we talked about how the mortgage interest is deductible. Well, if you don't have a mortgage, there's no deduction there for you to take. So your tax benefits might be reduced a little bit. And then the hedge against inflation. You still get the benefit of inflation on the asset value, you know, as we discussed, but you no longer have the benefit of inflation on your debt, on that eroding debt. Of course, appreciation is the same. So when I've heard people make a case for using leverage, for using a loan, even if you have enough cash to buy a property outright, this is what they're talking about. Look at how the return is diminished by being a cash buyer. It kind of moved around some of the returns. So what about the scenario of super high maintenance costs? I have a personal anecdote with this. My husband and I's portfolio, we had a couple properties last year that just did not do well. We had nature problems. A tree fell on a part of the house. We had some major plumbing problems. It was just a bad year. We had a lot of vacancy. And so we were getting really down on ourselves as every month, as you know, rent checks are coming in and the vendor fees or vendor invoices are coming in. We're getting more and more down on ourselves about the cash flow performance of this property because it's cost a lot of money to fix it up. And so what we do at the end of every year is we sit down and we look at each property and we look at all 5 profit streams. So in a high maintenance year, my cash flow was negative. It was terrible. My principal pay down was great. It was unchanged. That tenant still paid me rent. So that was the same. The tax benefits were actually a little bit better because I was spending more money. I had more expenses on that property and I definitely had a loss on my tax return. The hedge against inflation was unchanged and appreciation was unchanged. So when we zoomed out and we looked at all of the profit centers, that really bad year didn't look so bad. And I encourage you to do the same with your portfolio to really understand how it's performing holistically. So this next one I think is on a lot of people's minds now as we're in the post-COVID war, or post-COVID life. I don't know if we can say post, maybe we're in the middle of it, but this is on everybody's mind. I mean, what happens if I place a tenant and they don't pay rent? Or what happens if I have an extremely long period of vacancy? So let's put that through the test. Cash flow, well, that's eliminated if they're not paying rent or it's vacant. So that one goes away. Principal pay down, that one goes away too. I'm still having to make the mortgage, so principal is still accumulating over here, but I'm paying it myself, right? So that's not ideal. That benefit is definitely reduced. The tax benefits, again, just like with a high maintenance, they're gonna potentially go up because I'm not having any income from that property. It's gonna be a loss. The hedge against inflation, that one's still going strong, whether I have a tenant or not, both ways. And then appreciation, also unchanged potentially. So even not having a paying tenant in your property, it's not desirable, certainly, but you can still have a sound investment. I think my biggest point to this one is, especially during the times of COVID, is you got to have reserves. You got to be able to weather this short-term circumstance so that you can focus on the long-term benefits of owning property. So it's still a good time to buy, even though there is this risk of non-paying tenants, but you want to have ample reserves just in case. And then the final one, what about if there's a down market when it's time for me to sell? What if, you know, I'm under some kind of life circumstance where I need to get out of this property, I need to access that cash, but the market cycle is bad. Well, let's put that through the test. Cash flow, if you have, well, I should back up and say this. So this one we're looking a little more retrospectively. You can sell when the market is down, and appreciation is obviously going to be what is impacted. You didn't get the kind of growth maybe that you were expecting, but look, you had these 4 other revenue streams during the lifetime of the investment. And I would go further to say that if you buy the type of investment property that we say you should, that is affordable property, then that positively cash flows, then you might not need to sell that property. You can weather that little bit of a pullback, that little bit of a downturn, and get through it, let it recover. You don't have to sell because all of these other income streams support the asset, so that you can time it right. So I put this up here just to really encourage you. Don't get super obsessed with one of these income streams. This is the benefit of investing in real estate. There's 5. So to focus only on cash flow and to look for the highest cash flow you can get, period. And to let other great deals kind of slip off the table is to not look at this holistically. So I hope that helps you kind of conceptualize some of that. So you're probably like me now, and you're feeling really excited about this, and you're wondering, well, heck, this is awesome. Why aren't more people doing this? If this was so great, if real estate was so foolproof, how come everyone's not doing it? And I've said that myself. And the answer to that is, I think, 2 things. One, there's a learning curve. There's a lot of information that you have to understand in order to start executing a strategy. And 2, people don't know how to do it. Maybe I want to live in a high cost area, so I recognize like I've got to buy out of state. The barrier becomes, how do I find a market? How do I find someone who's trustworthy that I can work with, that can really walk me through this process and help me get into good houses and then manage them for me over time? So yeah, if that's the 2 barriers, this is where RealWealth Network really shines. At RealWealth Network, we are all about simplifying the real estate investing process. So these are our co-founders, Rich and Kathy. They're awesome. And they really embody this lifestyle of freedom and living life on your own terms. We create passive income for ourselves, not so that we can be monetarily rich, but so that we can be free to do what we want with our lives. That's the real value of being on this earth, is your time. And so we're really passionate at RealWealth Network about teaching people how to do this and then connecting them with resources that allow them to make progress. So here is how we help our members. First and foremost, we educate. We have a ton of free education resources on our website. They're free, and most of them are public, so you don't even have to register to get access to all of our education resources. We offer you industry connections. So once you join RealWealth Network, we can start connecting you with people who can help you make this process possible. So we can connect you to experienced lenders who work almost exclusively with real estate investors. We can connect you with really qualified CPAs, attorneys, 1031 exchange intermediaries, self-directed IRA intermediaries, you name it. We can connect you with people who can help you make progress. And it's free. You get access to an experienced investment counselor like myself. There's actually 4 of us, myself, Ben, Aristotle, and Joe. All of us are real estate investors, and we daily monitor the listings that all of our property teams in about 15 different markets across the nation. We monitor their inventory. We're very familiar with the economic drivers of those areas and what are typical returns. So we're able to have one-on-one conversations with investors about what their investment goals are and how they can get there. And we can really kind of create a customized strategy to help you move forward. And that is also free. And then this, I think, is one of the biggest benefits of investing with us, and that is you get to take advantage of the combined power of a collective. That's priceless. Because we know we are stronger as a group of investors than we are as individuals. We have over 50,000 members across the world, and we've helped those members acquire well over $1 billion worth of real estate. So we have some serious leverage when we're talking with these companies in these markets and we're looking for deals. They want to do well for us. They want to do well for our members because they value the connection to educated investors who are ready to go. So all of this is available to you. All right, so what's next? So you want to join RealWealth Network to get full access to all of our resources. You want to educate yourself. Like I mentioned, there's a pretty steep learning curve, so you got to spend some time getting into the weeds of how this works. You want to speak with your investment counselor. We can save you time. We can make this process more efficient. You want to get pre-approved with a lender. This is really the gas in the tank. Your financing strategy is really what informs your acquisition strategy. So be sure that you connect with a qualified lender first and foremost, someone who deals with real estate investors. And again, we've got a list of those for you when you create a login. And then begin to leverage the RealWealth network of property teams. Again, we've got 15 different markets that we have connections in, and they bring us just an endless stream of investment property. And then before you know it, you'll be on your way to getting into your first deal, your first property.